Who doesn't want a stable and secure and big paycheck? Well, apparently rich people. I'll show you. This is an article from Business Insider titled 13 Top Executives Who Earn $1 Salary or Less. And who do they have? People like Larry Page from Google, or Larry Ellison from Oracle, or Elon Musk from Tesla, or Mark Zuckerberg from Meta. Now at this point, I already know what you're getting ready to type. You're about to say, but Jaspreet, yeah, it's easy for them because they're rich. That's not the point. The goal is for you to understand the financial education behind what rich people are doing. That way you can make yourself rich or make yourself richer. Not to mention the fact that just because somebody's salary is $1 doesn't mean they're only making $1. Let me explain. Let's stick with the Meta Mark Zuckerberg example to make this simple. Mark Zuckerberg owns about 13% of the Meta company. I try to draw this out here. This is his equity in the company, and he's also a CEO in the company as well. That means that Mark Zuckerberg is an owner in the company. That's what he gets with his equity, but he's also an employee in this company. As an employee, he gets a salary. As an owner, he gets the profits. So let's start with the most basic part of this. How are you taxed on your salary versus your profits? And as an attorney, who's not your attorney, what I can tell you is that your salary income comes with higher tax rates and lower tax deductions than the money you make from your profits. Let me explain. If you live in California and you make $100,000 a year from your job, the first thing that you're going to pay is your federal taxes, which will be about $14,000. The second thing that you're going to pay is your state taxes for living in Cali, which is about $6,000. And then the third thing that you're going to pay are your FICA taxes, your Medicare and Social Security taxes at $7,600. And your FICA taxes are technically actually double that because your employer, your boss, is also going to have to pay $7,600. So if you're the employer and the employee because you own the company, then you're paying both sides of the FICA taxes. If you're just an employee, or you're just paying the $7,600 out of your own pocket. But now let's compare that to making $100,000 through profit, not your salary. You make $100,000. You still got to pay your federal income taxes. You got to pay your state income taxes, but you no longer have to worry about the FICA taxes. So the $7,600 you have to pay when you're an employee, you don't have to pay when it's a profit distribution. Plus, if you own the company, that means you get to save on the FICA taxes on the employee side and the employer side, which means you're essentially saving about $15,000 by paying yourself a profit instead of a salary. Now, a little disclaimer here. There are rules and regulations as to how much money you can take as a profit versus a salary. So before you go out and do this, make sure you talk to a licensed advisor in your area. But it just goes to show you that when you get paid from your profits versus your salary, you don't have to worry about FICA taxes. And in addition to that, you can also qualify for different deductions here from your profit distributions than you can from your salary. And also, which I didn't cover in this video, depending on how these profits are distributed and what type of company you are, this profit can also be a lower tax rate. But for the purposes of this video, for simplicity, all I wanted to show was that when you make money from profits versus your salary, you can pay lower taxes legally. And the second disclaimer that you want to understand is that your FICA taxes also stop after your income exceeds $168,000 a year. But this tax part is really just the beginning, which brings me to the second part of this video, which is really where the wealth is built through this. So remember what I said just a couple minutes ago, which is that Mark Zuckerberg owns 13% of the Meta company, and he's also a CEO inside of the company. So we kind of talked about the salary, but now let's talk about this 13%, this equity. Now what you want to remember is that the valuation of this Meta company, this stock, you can kind of think of it like the net worth of this company depends on how much profit this company is making. What do I mean by that? Well, let me give you the technicals and I'll explain what this means. The Meta company is trading for 27 times earnings. What that means is for every dollar of profit the Meta company makes, the valuation of this Meta company essentially is going up by $27. So let me give you a hypothetical to break this down. So let's assume that my company makes $1 billion a year in revenue before expenses and is trading for a 5 times multiple. Now, in order to understand how much this company is worth, I gotta know the profits. And let's assume that this company has, I don't know, $500 million a year in expenses before I pay myself a salary. So before I pay my salary, that means I have a net income of $500 million. Assuming I pay myself a zero salary, that means now that this company will be worth $2.5 billion, 5 times the earnings, 5 times the profits. But I got to pay myself a salary, right? Because if I have no equity, I got to pay myself something. So now let's assume that I need the big bucks. I need a big salary to make me feel comfortable, and I want to make $200 million a year. Well, that $200 million a year is an expense for the business. That means now instead of having $500 million in expenses, we have $700 million in expenses, which means the profit is only $300 million. Now, if we take the $300 million and multiply it by 5, that means now this company is worth $1.5 billion. You can see the difference between me taking a zero salary versus me paying myself a $200 million salary. I take out $200 million, but I lose $1 billion in valuation. The reason why I lost $1 billion in valuation is because every dollar I take out of the company is worth $5 of value, because it's trading for a 5 times multiple. So now if we bring that back to what's happening with the Meta company, according to the numbers today, at the time we're recording this video, the Meta stock is trading at a 27 times multiple. It's trading for 27 times earnings. That means for every dollar Mark Zuckerberg takes out in expenses, the value essentially falls by $27. Now I get it, it's not an exact number, but it gives you an idea of what's happening. So if Mark Zuckerberg took out $100 million for himself as a salary, that's a $100 million expense, which means the profits would fall by $100 million. But the value of the stock would essentially then be hurt by 27 times that. That would be a $2.7 billion difference, because it's a 27 times multiple of the profits. If the profits fall by 100 million, then the valuation falls by 2.7 billion. But now here's probably the coolest part of all of this, so let me tie this all together. When you pay yourself a salary, this is an expense. And so it reduces your profit of the company because you have to pay yourself a salary out of the revenue. But when you pay yourself a profit, this isn't shown on the expenses, because this is what you're doing with the profits. So your salary is a part of the expenses. Your profit distribution is not a part of the expenses, because this is what you do after you determine what the profit is. So now, let's just say you want $100,000. If you take it out of a salary, well, that's going to affect how much you're paying in taxes, and it's also going to affect the valuation of the company. But when you take it out of your profits, you can get potential tax breaks, but it also doesn't impact the valuation of the company as well. Now, yes, there are nuances to this. I get it. Every single accountant, every single business owner, every single venture capitalist watching this is going to say, yeah, but there are nuances to this because you have to account for some sort of salary for you. You have to account for some sort of this and that. I get it, but you got to understand the principles. That way you can understand how you can use this for yourself, because if you don't understand the principles, you can't use any of these concepts for yourself. So let me break down now how you can use these principles for yourself, that we can understand what rich people are doing and understand how you can use these same concepts for yourself to make yourself rich or make yourself richer. By the way, just to hammer this home one more time, this is why Mark Zuckerberg only made $11 in salary over the last 11 years, but his wealth grew by almost $50 billion. So how do you apply this for you? Well, the first thing is understanding that Mark Zuckerberg is working for this: equity, not salary. That's the first thing you have to understand. Now you might say, but Jaspreet, I don't own a business. How do I work for equity, not a salary? Well, you don't have to own your own business. You don't have to start your own business to do this, because guess what? People own the Meta stock. Mark Zuckerberg owns 13% of the Meta stock, which means other people own 87% of this stock. So if you want to now take advantage of the same thing, you have to understand this equity. You don't have to necessarily go out and create it. If you're an entrepreneur, great. You can go out and create it and build a lot of wealth that way. But if you can't go out and create, the second best thing that you can do is you can go out and buy it, because 87% of Meta is owned by other people. Mark Zuckerberg's wealth is built through just 13% of this because he was able to create it. He didn't have to go out to buy it, but he sold a piece of it to other people, which allowed him to build that wealth for himself. So if you build kind of a financial statement for yourself, what you're doing is you're going to work to generate an income. Out of this income, you're going to have to pay taxes. That's going to be automatic if you're getting a W-2 salary. So now you pay your taxes, and then you have some money that hits your bank account, and then you pay for your expenses. You got to pay for your house, your car, your groceries, and everything in between. And then if you have any money left over, this is now the money you want to convert into this equity. Now, when most people think of equity, what do they think of? They think of, oh, I want to build equity in the home that I live in. But unfortunately, that's one of the worst kinds of equity that you can have when it comes to actually building wealth, because this home that you live in is not making you any money. Now, sure, maybe it goes up in value, but you don't actually realize that money until it comes time for you to sell, and then you don't have a home. And you have to pay every single month to live there as well. You got to pay for the property taxes, the insurance, the maintenance, and everything in between. Other types of equity that actually build wealth, what wealthy people are working towards. Because if we talk about any wealthy person, like even the wealthy people that I talked about in this video, none of them got wealthy because they paid off of their home. The way they build wealth was an equity in something else. So this can be equity in stocks. It can be equity in real estate rental properties. It can be equity in your own business. That's the equity that is building the wealth. And now the nice thing about this equity is you're working for the profits. You're not working for the salary, right? You're working here for the salary. You're going to work every single day to generate this income. You got to pay taxes on the income. But guess what? When you go and work to generate money for your investments, now you qualify for the first thing, which is the tax benefits. As an attorney who's not your attorney, what I can tell you is if you invest in the stock and you own the stock for more than a year, and you sell it for profit, this is called long-term capital gains. And this is taxed at a lower tax rate than the money you make from your job. So if you made $1 million from your stock market portfolio, and you made $1 million from your job as a surgeon, as a celebrity, you're gonna spend half of this money in taxes. When you earn this money from your job, half of it's going to taxes. But when you made this money from your stock market investments, 20% is going in taxes. You get to keep more money for yourself. And then the second thing is you can also qualify for more tax breaks as well. When you go and invest your money in real estate, guess what? Now you also get to qualify for more tax deductions to lower your tax liability. When you go and get a dividend from the stock market, if you go out and invest in the Meta stock, for example, I'm not telling you what to invest in, I'm just giving you an example. When you get a dividend from Meta, when this profit distribution hits your bank account, because that's what a dividend is. A dividend, which not all companies pay, but some companies pay this dividend, which is a quarterly check. It's a payment that automatically gets deposited into your bank account where the company that you invest in, the stock, has a lot of cash left over. And what do they do with that cash? Well, instead of reinvesting this cash, they just give it away to the shareholders. They give it away to their investors. Now, not all companies pay a dividend. You got to figure out what the dividend is, but this is money that gets deposited into your bank account. Now, the nice thing about these dividends is the tax rate on these dividends are also lower than the tax rate you pay when you make your money from your job. The money you make from your job, your ordinary income, your W-2 income is taxed at the highest tax rate that our tax code has to offer. When you make money from investments, whether it's stocks or real estate, you get to qualify for lower tax rates and higher potential deductions. But now you also are not just relying on your income to get paid, because now when you go out and invest in another company, guess what? Now the company has employees that are working to grow the profits, to grow the value of the company. Now, are you guaranteed to make money when you invest? You gotta understand this. You gotta understand this. You gotta understand this. You're never guaranteed to make money when you invest. In fact, you will probably lose money at some point. Every investor does. So make sure you do your own due diligence and never blindly trust a random guy on YouTube. But this is where you got to understand that wealth is built through owning equity. Wealth is built through investing your money. Wealth is not built through your income. Look at what wealthy people are doing. The reason why wealthy people don't want a big salary is because they know it's going to cost them the most money in taxes. It's going to cost them the most money in the valuation of their investments. It's going to cost them the most money long term. They want to see the value of their investments rise, not the value of their salary rise. Now, of course, you got to pay for your groceries, you got to pay for your house, so maybe you can't do that yet, which is fine. But what you can start thinking about is how can you start improving the value of your equity, because that is what has built the wealth for every single wealthy person in this country. So now you got to start putting on your investor mindset, you got to start putting on your wealthy mindset and understand how you can do this for yourself. And that means now you don't spend all of your money, so you have money left over, so you can go out and invest in things like stocks and real estate and maybe your own business. Now, I do want to kind of give you a little piece of caution here, because it's very easy to get caught in the trap of, oh, this is the next hot stock, or markets are crashing, or these emotional investing decisions. And this is where I want you to take a step back and understand, number one, market crashes happen. They're a part of our economic system. Use them as an opportunity to buy more, not as an opportunity to sell out of fear. Number two, I want you to understand the trends. I want you to understand what's going on, and I want you to not let the emotions get to you. An easy way to understand this, Market Briefs is a free newsletter that my team created at Briefs Media to break down what's happening in the financial news in 5 minutes or less, and it's completely free. If you have not joined Market Briefs yet, I got the link down in the description below. And number three is understand that investing is a long-term game. This is not something that happens overnight, over 6 months, or really even just 6 years. I mean, if you got to give it time for your money to grow, that means years and decades to really see the long-term growth of your investments. But that requires the discipline to keep investing your money, because that means markets go up and down, and you just got to keep investing your money, working to build that equity. That way you can have more investments that are working to make you even wealthier. That way you can win in this economic system. If you got a lot of value out of this video, I would love it if you could give me a thumbs up and subscribe to this channel. Well, I have this money. It took a lot of work to put aside this $10,000. I don't want to lose it. So what can I do now to invest this money with the least risk possible and also the fastest way possible? See, it's kind of a difficult answer to answer here, but the way that you can do this is by understanding, number one, how do most people lose money in the markets, and then number two, not do that thing.